So if I look at 12, it was better than 11 in terms of the overall M&A trend. Obviously not the good days of 6, 7, 8, 9 in that sense, of 6, 7, 8, 10 in that sense. But 11 and 12 were good, but 13 again, whatever we've seen in the 9 months or just about 9 months is not as good again. And I was reading one other statistics, and which was quite depressing in that sense, is that if you look at only emerging market deals, India's share in 2013 is only 5.1% of those emerging market deals. So I mean, we are at a very, very low threshold. And why is this all happening? Again, the lion, So we have Vodafone, somebody wins in the Supreme Court, the Parliament goes and undoes that, and several such things, which is rankling so much in terms of deal happening, deal dynamics. I mean, look at the recent one on GAR. We know it is going to come in 2015. India is not going through its best of times. Is there so much of hurry to bring it now? You could have waited what they brought it now. If it had come 1 year later also, it did not make any difference, to my mind, from what has come. So, those are the things which are pushing us back, because the international community is looking at it from a very different perspective. And whereas we are still, with the 5% or 4.4 or wherever we end up in terms of the growth, still not wanting to take the talk that we do with the walk, as I say. So there is a huge difference between the talk and the walk. And I think that is where I think the entire thing will span out. And that is where we need to be, very, very fast in doing things, in understanding things, and in changing and, getting our right approaches to creating value. Because I think at the end of the day, if A doesn't create value and B creates, everybody will move towards B. And that's very clear. So I think everybody needs to be in that race to create value. And I think maybe restructuring is one such way to look at it. Even from a M&A deals in India, cross-border versus, domestic, I think there is a certain slowdown current year in particular. So obviously we need to be, looking at how to make and create deals. And increasingly, year by year, the issues that are surfacing, and I can tell you now that some of the things that people don't even sign term sheets till they know what structure they are going to use. So I'm in the midst of a deal where they have stopped signing a term sheet because there is issues on the tax structure. There are different viewpoints from the seller's perspective, there is a different viewpoint from the buyer's perspective. Unless there is a common ground, they don't even want to sign the term sheet. Forget the due diligence. So I think that is the level of issues that people want to upfront now discuss when it comes to deal making. And I think that's very important to note, because and that may be one of the reasons why we are not seeing too many deals. So what are the reorganization prerequisites, as one calls them? And there are several of them, So if you were to look on the commercial side, we start with the business synergies. So if you look at, Ultratech's recent acquisition of JP, I mean, there are several grounds there why they wanted to do it, So it could be more competitive positioning, it could be core competency they are there. So, one more addition to their kitty will always help. And it's a huge transaction because it's almost 4,000 crore worth of transaction, because the enterprise value is as high. And it's a very clever structuring, and we'll talk slightly about it, as we move into it. It's a very, very clever structuring. If somebody has followed it, it's very, very nicely done, so that it benefits the seller, but it doesn't cost the buyer, in that sense. So it's very, very, uniquely done. Again, there are several other reasons that, people would merge. So inorganic growth is one of the biggest reasons. And, one of the latest ones that comes to my mind is the CIE acquisition of Mahindra Systech. They've now become a 51% almost. I think it should happen anytime during this month. So that's because they were not present in India. They were present in Spain, they were present in Brazil. And that deal is also very differently structured again, because it is not only CIE investing in the Mahindra group, but Mahindra investing in CIE itself. So it's a double way joint venture, if one can call it. Because Mahindra's hold a percentage of the balance Systech, whereas they are also holding in CIE, and CIE in turn is holding, into the company here as a 51% holder. So it's a very unique. So it's cash neutral to an extent for CIE, And in that sense, whatever monies are coming into Mahindra's is getting reinvested into CIE as a whole. So it's a very different way of structuring a deal. I don't think we would have thought about it 5 years back to look at it, how to make it cash neutral in a different way. And it has its own challenges, obviously, because you have to comply with several regulations when you're looking at, sort of a cross deal or double cross deal, if one can put it in that sense. Greater control over assets and operations. So, the biggest one that comes to mind in recent times is the Wholesome deal. Through a very innovative structure again, they have tried and, created a greater control over the companies. Mind you that they have given up a stake in the second subsidiary, which is ACC. But at an overall level, the control has increased, if you look at both the companies in terms of the control. So economically, they may still be in the same vicinity, but overall control, they have increased. And I think it was done earlier also when we looked at how Ultratech was formed and how the cement division from Grasim moved down. In the process, they created additional maneuverability or flexibility to raise funds because their holding as a group moved up to 61% in the cement division, allowing them a 10% flexibility to raise funds further. So because if you control, if you're 51 or 61, from a control perspective does not matter, but it at least gives you the headroom to raise finance at a given point of time. So I think there are different such ways that people look at it, not necessarily only the economic interest, I think. So that's very important to look at. Or if you look at strategic alliances and partnerships, where several of them have happened in the country. That's another big area. So the Volvo is the most successful one that one can talk about in the Eicher Volvo joint venture in that sense. It's highly successful. I mean, it's created so much value not only for those two promoter groups in that sense, but also for the shareholders, because that value creation has been quite high. Or unlocking of value. I mean, again, as I said about the Grasim deal, there is a lot of unlocking of value on that deal, and there are several such other examples. Apart from the commercial, I think there are sometimes the need to create from a financial perspective value for the group. So you have multiple companies, can you fold them and create one? And if there are some in losses, some in profits, overall the tax burden of the group reduces as a result of that, or at least it is postponed till a later date. And like in every crisis, cash is always the king. If you are not in a crisis, it's okay if you have lesser cash, but if you are in a crisis or in a situation of a slow growing economy, cash is always very important. And therefore financial parameters come into play very often, and in corporate restructuring quite a bit of it comes into play. So whether it is tax savings, and clever examples of that are that you had promoter holding through an intermediate holding company, and you fold them up so that dividend distribution tax gets reduced at one level, is done by several companies, seen and therefore benefited in terms of overall reduction of tax from a group or a promoter perspective. Upstreaming of cash, very important now, because we have a new legislation which has kicked in from the 1st of June this year, which is called the buyback taxation, or the buyback distribution tax in that sense. And how do you plan around it? What do? You still want to upstream cash. Are you going to pay that 20% and then upstream? Then it doesn't make any sense beyond a point. And is there different ways of looking at it? And are there ways to overcome it? So for example, can you look at a simple buyback not under 77A, but through a court scheme, which is parallel to a 391 scheme to do a cash extraction, and that may not fall under the buyback taxation. Then it takes you back into whether it is dividends or whether it is capital gains. And if it is capital gains and you from a treaty country or you have certain base, then it becomes easier for you to claim that benefit. Or you have a capital loss, then you can offset that capital loss against that capital gain. So there will be several such planning opportunities that one needs to look at, because as more and more regulations come in, which will create hurdles in certain things because of whatever is the thinking, we will have to keep on innovatively start thinking about what is the way out. And I think that's where, everybody of us here has a larger role to play as to that if a certain commercial or a financial aspect is to be achieved, is there a way? And obviously when you do something which is outside the textbook, there will always be a level of risk, right? There cannot be 100% pure scenario when you take something outside of the textbook in that sense, or outside of the IT Act, which is not directly provided in terms of exemption. But is it a calculated risk to take, or is it just a flamboyant thing that one wants to do? Needs to be appropriately measured in a given case, and it will depend on what is the appetite overall that one has after considering several technical parameters as to whether this can survive in a court of law or whether it will be thrown off. I think those are the critical elements that come into play, and more corporate reorganizations are being challenged by the tax office. Recently we've seen several such cases where during the course of hearings they have come and tried to put their points of view, and I think courts by and large generally till date have said that if there are ramifications under tax law, then those will anyway follow. They should not come and create an objection to the scheme, if so long as it is within the overall framework of the provisions laid out under the Companies Act. But going forward, we will see that there is a huge change in how Companies Act looks at it. The 2013 Companies Act, when I say Companies Act, while not notified, but there are several changes there, and we'll cover them so that we keep that in mind as we frame more and more innovative and different types of schemes. So from a financial parameter again, as I said, encashing value, cash infusion in operations. So most of the private equity deals are primary deals, and that's with a view to fund the operation and take it to the next level, so that the sustainability of the operations can be maintained or grown, and therefore there is a possibility to create value from that perspective. And we talked about the larger dividends. So I think this is the place where CFOs can play a very important role in identifying, is there any situation that they can look at within their own parameters or own company group and all of that, to see are there any way that they can enhance the overall cash within the system, or whether they can increase the overall value from a promoter perspective, because that's one of the important but unsaid expectations in that sense, because when anybody gets an appointment letter, it's never said that promoter value creation is a part of the job, but it is an unsaid but important element of any CFO's role. So that's very important to keep at the back of the mind. So again, how have fundraise happened in the past? And there are different ways. So through the split mechanism, as I call it, and there are several splits of that type, the vertical, the horizontal, and the hybrid splits. And in each one, there is a different way and a different element that is involved from a fundraise perspective. Or the reverse of it is, sometimes through a consolidation, through a slump sale, or through a demerger that you would raise funds. So again, one needs to look at which one will be more applicable in a given situation, and therefore look at it from that perspective, so that it can be A, done with quick speed, B, it has the least fiscal impact, both in terms of income tax or stamp duty perspective, or indirect taxes in that sense. So what's a classical vertical split? It's a very classical demerger, as we all know, and I'll run this through very quickly, so that we can cover the more dominant parts of the presentation in further detail. And basically you just split the two businesses in the two companies. So you take out one of the businesses and hive it off and put it into the other company. And if an investor is interested in only one of the two businesses, he will come into that other business because he is only interested in, let's say in this case, the business Y, as is pushed down here, and not necessarily interested in business X. So that's one of the reasons why you might have to do, and split the business. And this is called a vertical split, because then, shareholders are holding in both the companies and you get the investor in one of them. And the value obviously gets split between the two companies, but always, wherever the investor is going to come, there is a value enhancement that will happen as the perception improves of that company, because a very significant portion of that in terms of the value perception is created by the investor, because he would have done his diligence, he would have done his homework, before investing the money in that company. So that's how the value creation happens. Downward and horizontal splits, basically this is also quite often resorted to in several cases. And here also, I think the critical element is how do you create a structure which will help the investor to come in the business in which they are interested in. And therefore, you push the business down and therefore have the investor come in that business in which he is interested. And especially if A is a listed company in this example, it is even more important because several foreign investors or several investors are very wary of investing in a listed company. And they are looking at investing in an unlisted company. And this clearly helps them to invest in that unlisted company. Secondly, from a management perspective, if this creates big value, it helps in the value of the listed entity itself. So that's very important to get into, because that will also create overall value for the group or for the listed company in that sense. So if you look at some of the critical examples around this is, when Musco transferred its steel business down into a 100% subsidiary to begin with, and immediately had an investor in the form of Mitsui, and therefore they were able to get the fundraise that they wanted for the steel business, because obviously it is not a core business of the group. So while it was earning money, it was fine to keep it with the group, but obviously to invest further, you need to have the right appetite and right approach in terms of what is going to give us back, what is the payback period, are we able to concentrate on it as a group, at that business, or we want somebody who is going to help us in achieve that while we sustain whatever we are doing currently. So clearly when you drop it down, you can get an investor there, and obviously the investor did not want to come in the listed company, which was Musco in this case. So it's an important way of creating value. Up till now, it's been good. Companies Act, there is no issue in terms of the transfer down. Income tax, depending on the value at which you transfer, there will be a gain or not a gain. So that's also by and large possible to create structure whereby the outflow of income tax or capital gains tax is much lower. Going forward, I am not sure whether this is possible. Why? Because if I look at the Companies Act provisions, they regard, in this case, Company A and the WOS as related party transactions, and any transaction between them needs to be an arm's length price. Now, how do you justify that arm's length price in a 100% WOS scenario? It's not going to be doable, because if I do at an arm's length price, which is, let's say, the fair value, then there is a huge tax initially when I may not be even divesting more than 20% or 25% of that business. So I don't know how we will have to intermingle the requirement of the Companies Act, at the same time be wary about how the income tax will look at it, and it's going to be a challenge for all of us. We're still struggling unless one can take a call that what I'm transferring is to my wholly owned subsidiary, and therefore from a governance perspective there is no issue at whatever value I transfer, because the full value is being retained by me in that sense. Still I bring somebody else, and so long as I bring whoever it is at the fair value, it should not matter. It's going to be a challenge, because independent board members are going to ask, how is this at arm's length? What is the basis of its being at arm's length? So we need to start working and thinking about it as to how we are going to address it. Though in the recent past, I have seen several schemes, and the latest one which is in the works is the L&T scheme, where they are transferring their hydrocarbon business to a subsidiary, and this transfer is at book value. Obviously, if Companies Act 2013 was there by that time, somebody would have asked, how is it arm's length? And I'm saying that why should we wait for 2013 to ask that question? The governance question should remain same, even before 2013. It can't be different just because 2013 provides for arm's length. But today the answer is very clear, at least that what most of the boards is taking, is that it is to a 100% subsidiary. There is no value leakage to any outsider, very clearly. It is between me and my 100% subsidiary. But now if the law requires me to do it at arm's length, then how do I address that? That's going to be the biggest question. And to my mind, that's going to be the biggest challenge in creating this type of splits. What does it mean? It just means that there is a way out under Companies Act that I need to go and get a shareholder's approval other than related party, so other than company A and its promoter group, maybe from the non-promoter group through a special resolution. So there is a way out, but it is going to be that much more difficult in that sense. So one will have to just go through it and explain the rationale much more in detail if one is going to do it other than arm's length, because it will require reporting even in the annual reports going forward, and the explanation will also be required there. So it's going to be much more disclosure that one will look at. So again, when you look at the downward horizontal split, I mean, one of the most interesting structures that comes to mind is what the Bajaj Group created 3-4 years or maybe now 5 years back. They literally split the company into 3 ways, leaving the main company with just being a holding company sort of a thing, and a sort of a small operation there. And they created an auto company, and they created a finance and insurance and that type of a venture. But the way they created is that the group now holds via that holding company a large portion, and then the family owns another portion of it. So their value is today in most of the companies, their control is above 50% plus in both of those key operating companies. So it's a very different structure, where when you push down the business to the subsidiaries, you retain the holding that the holding company has in the subsidiaries, and they did it through a tax demerger, and therefore issued balancing shares to the shareholders, and that's how they retain higher control in that sense into the 2 operating companies. So allowing them the leeway, so they were almost, I think, 62 or 63. So today if Auto wants to raise funds, till 12% dilution, it doesn't matter to them, in that sense. Obviously they have not had the requirement to raise funds, but I think they're just thinking of the future, that in case there is a need, can I create a structure today which will help me at that point of time. So that's how they have created it. And then there is this clearly what I call the hybrid sort of a split, where you transfer things down but you don't get a value for it. So you either gift it, and therefore then a new investor comes in and you raise the fund. However, limited value gets captured in such things at the parent level, because otherwise what would have happened is you would have also got the transfer value back into the parent. Here you are giving up that transfer value because you are either gifting it or or you are demerging, then it's a vertical split. So again, one will have to look at it. Some situations we have seen the gift route also being taken. Of late being challenged by the tax office if it is done through a court process, but I think it's been done. Funding options, again, quite a bit of them, and some of them work and some of them not work, but I think more or less I think everybody would know about it. And so right from equity, which is your main base, to compulsorily convertible, to convertible debentures, to preference shares on the other side, and obviously debentures and shareholder loans. So there's a lot of funding options which are available. But what are the funding option key considerations that one needs to look at? So from a regulatory perspective, apart from your commercial considerations, I think there are several aspects that get into the play. So what is it in terms of control and voting rights does it give? And in the past we've seen, on mergers, a lot of companies create treasury shares. And the idea of the treasury shares was primarily control, because and voting rights being available. The benefits obviously from an economic perspective were retained with, whoever was holding the shares, whether it was, the merged company or in the case of a demerger, the demerged company. Secondly, ease of repatriation. So if you fund something, how quickly can you take it back? What are the needs there? Tax efficiency obviously is very important, and then the regulations, whether it is exchange control or the company law. So those are some of the key considerations that come into play. And again here, Companies Act 2013 is very different than Companies Act 1956. Why? Because if you give loan to your subsidiary, again the interest rate needs to be as per the bank rate and whatever it needs to be. Up till now, you could have given a 0% loan to your 100% subsidiary. There would not have been too much of an issue, because Companies Act did not have any prohibition on that. But going forward, one will have to keep that in mind as to how to structure that, because any loan now to a subsidiary also needs what is the equivalent of the 372A approval or limits, or 186 limits are applicable to any investment. Whether you are investing in a 100% subsidiary, you still need to go through and look at the limits. It is not an exempt transaction anymore from a loan giving perspective or a 372A or perspective, or 186 in the new act. So one needs to be very, very careful about that aspect. So as I said, generally to summarize, what we've seen in several cases, how do businesses unlock value? So obviously acquisitions, takeover of sick entity, consolidation of operations, enhancing promoter holdings. So if you look at Holcim, in a sense there is an enhancing of promoter holding at a certain level, which allows them to have better control over the companies going forward. Tax saving and elimination of multiple layers on one side, to obviously demerger, where you segregate your businesses and therefore are able to sell or get investor in a more tax efficient manner. And then there are cases where you would want to do itemized sale, but obviously one needs to be careful about the indirect tax implications. And I have seen structures, especially where it is a capital intensive industry, where you can play in terms of an itemized sale, as we know under tax law or Income Tax Act, and still be regarded as a business for VAT purposes. And that play is very simple to achieve in a sense. Is if you look at, and all your agreements are saying that I'm selling business as a going concern, which is not a problem. What you need to do is that to that agreement, you need to attach a schedule of what assets are going and what liabilities are going. And if you simply write the values of those assets and liabilities, it becomes itemized asset sale for income tax, whereas it can still remain VAT, a business sale from a VAT perspective. And therefore VAT is not applicable to a business sale, it may be applicable to individual asset sale. And therefore if you overplay this two, you can achieve a much more better result, both from the seller's perspective as well as the buyer's perspective. So buyer may not gain, but he will not lose, let's put it that way, but seller may definitely gain, because he is postponing his tax liability. So let's say if there is a slum sale today of something at 100 rupees, I'm just taking a very wild example, and net worth of that company is, of that business which is being sold, is 25 rupees. And if I don't put that schedule with the values attached, then what will happen is 100 minus 25, 75 is subject to capital gains tax. And I'm assuming it is long term, so 22% we will pay. So roughly you have lost 16 rupees in broad sense. You're left with 59 rupees now, or let's say 84 rupees, sorry, 100 minus 16 is the tax, so 84 rupees. Now obviously as a seller, why should I lose that 16 rupees today? So if I had to split those, because it's a capital intensive industry, if I split those asset value with the values, it will go and adjust against my block. So I will lose a future depreciation, but if I am a capital intensive industry and I am going to keep on adding capital assets, I will never face that problem. So I have never paid that 16 rupees ever. So one has to look at all those. And I can tell you, at least in my experience, when somebody wanted to do a deal and we just changed it around to this, I could extract out of the seller, out of that 16 rupees example, okay, we extracted 35% for the buyer and reduced the price. So buyer is happy, he is paying a lower price. Seller is happy, his net retention is higher than what it would have been otherwise. So you are able to therefore give value and create value, either you are acquiring or you are selling. And one needs to look at it. It won't apply to every situation, but one has to be very, very fact driven in this type of a scenario. And be very clear that despite this type of structure, VAT will not be applicable. I think because otherwise this doesn't work. And look at a worst case scenario. VAT applies. If it is 5%, it may still be worth it. So you have 16 rupees of gain on tax, direct tax. You have 5 rupees of VAT gone, 11. You still split 11-5-5, you get, both of you gain. So one has to look at it again. So at times we try and see, let's look at the worst case scenario, let's play with the VAT also. So how does it work? Each scenario will be different, obviously. But one can start looking at it. So long as your other parameters are not changing, and I can just tell you one more thing, it will become so easier for the buyer in this case to claim depreciation on those assets because values are identified with a third party, rather than do a purchase price allocation and then sometimes being challenged. This is an internal thing, you have done it, I don't know what right, wrong. So you're away from all those challenges then. At the same time, you have gained at the cost of the overall tax reduction. Obviously, it has to be very clear that seller is going to keep on reinvesting in capital assets. Unless that model is there, it will not work. Because at some point of time, the lower depreciation will mean that you are paying off 34% versus the 22% today. So that's the other play that one will have to do. When will I pay up more 34%? If it is after 8 years, what is its net present value? Am I still better off? So one will have to play all of that. And that becomes very, very different and interesting. And that creates value. Because, as a buyer you are paying less, as a seller you are getting more. Who is the sufferer? Everybody knows. So, again, to my mind, people just want to look at slump sale, want to look at itemized sale, but try and do this interplay. And if you do this interplay, I still believe that in 4 or 5 out of 10 cases, it will work out to be in favor. It may not work out beyond that because I'm saying the asset base will determine everything, but at least in 4 to 5 cases, it will work out. Especially in brick industry, it will definitely work out. Maybe not in the IT space because it is not asset heavy. So one will have to look at which ones that it is, or infra space for that matter. It may still work out to be better. Quickly moving on to mergers again, primarily the consolidation. So when Sujal and I were working on the Centurion Bank of Punjab, we thought the best is to do the merger because it just allows 3-4 reasons. It allows no takeover code, so no buying of minority shareholders. It allows a deal to be done without cash consideration, so it's a swap. And it allows synergies to flow from day one once the merger is done. So clearly merger becomes a very, very important element. If you look at the current JP deal, and I'll cover it slightly later, it's also very similarly driven. But there is going to be challenge going forward to my mind. Till now we are all used to High Court approving mergers. Once High Court approves mergers, all your other departments, whether it is water department, whether it is the land conveying departments or stamp office, everybody acts very, very properly with you. Electricity, whatever. Once there is a tribunal order, I am not sure how they will behave. You will say, which tribunal, who tribunal, I don't understand. There is no court order. I will take my own time. So the challenge that is going to be faced by all of us going forward, and the Companies Act comes into play, is how to operationalize the merger. So today, somebody asked me that if I want to acquire a business, why would I not do a contractual sale? Because I can finish it in 45 to 60 days, everything including shareholder approval. I said perfect. Because a merger would take 6 months, 7 months, general time frame, especially Bombay if you were to talk, 6 months, 7 months depending now because listed, unlisted maybe 4.5 months, listed 6-7 months. I said, but you don't realize the process. Are you saying that the process is over when you acquire the business, or the process is over when you get all the registrations in your name? And if you feel that the process gets done when all the registrations are in your name, then you'll end up at the 7-8 month, 9 month period only. Because when you take a contractual sale to any babu, if I were to call them, in any regulatory office, he will sit over it and he will want to work his way because it's not a court order. So what time you are saving at the start of the process gets usurped at the end of the process. And you feel so frustrated, and I've heard several people talk about it, that if they had done the merger, it would have been quicker. Because They could have used the court order and say you are doing contempt of court if you are not doing this. And that works, and I've seen that works. That contempt of court is so high in their mind, because you just need to go back. If they are not doing, you just need to go back to the court and say, please give us this additional order, and then strictures can be passed. And therefore, practically, court orders have been implemented faster, to my mind, than some of those contractual sales, especially where you need a lot of places where registration needs to change. So that's very important to know, because it again it's easy to do, quick to do. You close the deal between the two parties, but then as a buyer, you need to do a lot of more process before it can get done, and your legal department will be running into it a lot more. So it's very important to know that. And therefore, sometimes even slum sales are structured through the court process. I can talk about an alcoholic beverage industry where you will not see a single slum sale happen through a contractual merger, because that industry is plagued with state excise licenses. Now, if you are in 3-4 states, you don't want to jeopardize your state excise license. It's very, very, very difficult then to operate in that very, very highly licensed industry. Once you have the court order, it just becomes binding on those guys, and just becomes smoother to get the transfer done. And I think similarly for demerger, again, several times you look at demerger just from that same perspective, and obviously the tax neutrality. So if I look at the JP and Ultratech deal as of now, it offers full tax neutrality to the sellers, because they will get shares in Ultratech, and if they dispose them off in the stock exchange, it's going to be tax free for them. And under the Indian accounting standards, if you are getting shares in lieu of something else, they need to be accounted at their fair value. Therefore, they may not be even MAT when they sell the shares. So when I look at AS 13, which is the accounting standard on investments today, so let's say there is a holding company, it has 2 subsidiaries, and it is merging A subsidiary into B subsidiary. When it gets the shares of the B subsidiary as a result of the merger, it needs to record that at the fair value of B and record an accounting gain. So if you can plan that right, that if you do that accounting gain in a year when you are under normal tax and therefore not under MAT, and then when you actually sell it, there is no profit at that time, because you already booked your accounting gain. And if you sell it on the stock exchange, then anyway there is no capital gains. So you come out of MAT, you come out of normal capital gains. So one has to look at which scenario will apply in a given scenario. So again, there are several such aspects which are very important, and when you are looking at subsidiary merger, we certainly forget the holding company and the implication in the holding company, because what is it? We just need the resolution to be passed and their approval. I mean, that's the type of thinking that we will always do. But see the implication, because if that accounting grade creates a MAT, then you are unnecessarily paying tax today, which you could have postponed depending on how the situation arises. So it's very important to look at, yeah. Yeah, right. So they will get the shares of B based on the fair value of shares of A. But in my books, I would have acquired them at cost. Who knows? Which may be 10 rupees par value. Or let's say even if I have acquired at some value, it may not be necessarily the fair value today. So that differential will be put into the gain. So as I said, slum sale, I've discussed this, in greater detail. Itemized asset sale, again I covered and touched upon it. So what are some of the tax planning opportunities for you all to look at within the group? And I think the most important is that, in these times, especially when businesses are going through whatever challenges, whatever cash saved is very helpful. And therefore, can you look at merging companies where there is profit, where there is loss, so that as a group, the tax that you pay in a given year is saved, because this merger allows you to offset the loss making business, the loss in the business that is making loss versus the profit in the other business. because as a group anyway you're going to make that loss if that business is not doing good. So why pay tax in the other company? So that's, I think, one of the most important thing that one can look at. Or if there are accumulated losses, then you can use those also. And one can plan around those use of those losses of the past. Especially because if you look at 8 years is the maximum time. So if some of them will lapse, if your business plan is not showing that type of an improvement, then you may want to plan this also from that perspective. And the downside, obviously there is a stamp duty cost. So while you may want to gain on the tax side, you need to just weigh it against what is the stamp duty cost and do that cost benefit analysis. Yeah. Sorry? MAT tax in what? Yeah, but when you merge, even the book loss will come of that year. So to that extent, your MAT will get adjusted. Carry forward, that will be the issue. Clearly. But it is a 1 year issue then. But at least you are dropping from 33 to 20. So even there is that benefit. Plus, obviously NPV wise, 33 is gone forever. 20 is recoupable over next 10 years. And if you are back into your normal rate, then maybe 2 to 3 years or maybe 4 years you will be able to recoup that, 1 time or 2 year issue that will be there. So even from that perspective, the NPV may not be as high compared to a loss of the entire 33%. And I have not seen any situation where it is, the MAT is becoming so much of a block, if I can put it that way. So the MAT planning now, since you raised the MAT issue, I thought we should cover that. So primarily here what we are saying is that many tax holiday companies are now required to pay MAT, and obviously if you have companies in the group which has tax holiday units and therefore in a separate unit or separate company versus a normal corporate tax paying company, if you merge the two, to an extent that MAT can be saved because it will be absorbed by the corporate tax that the other company will be making. It may not still be completely out of MAT, but if you combine the two, it will still be better at any given point of time. The only problem and the only vigor and only issue that one needs to keep in mind is how do you segregate common cost in that scenario, and it needs to be appropriately, that cost allocation needs to be appropriately done so that you don't end up with the tax office in terms of whether the profit of that 10A unit or whichever unit, I mean SEZ now, or ATIA or ATIB would be in a problem. So one needs to just be careful about that planning and keep that in mind and keep that allocation appropriately done of common cost, because that becomes the only issue when both of them are in a single unit, in a single company. The next is LLP, and generally I would not have covered LLP as much, but with the Companies Act again 2013, this is increasingly becoming an important element to look at. And why do I say so? Because up till now in Companies Act 56, there is a huge distinction between how a private company can run and how a public company can run. Whether it is listed, unlisted separately, but public and private, there was a huge, and there were a lot of exemptions, privileges which are available to private company. Most of them are gone if I look at Companies Act 2013. So is there a necessity to be a private company now? Why can't I look at different structures? And if LLP is one structure, can I migrate to LLP? At least it will help me from several perspectives. If nothing else, dividend distribution tax will be saved if I need money into the promoter's hand. If nothing else, I am saying. So it is increasingly being talked about, obviously not implemented to that extent, because Companies Act is just 1 month old in that sense. But I think this will become more and more in vogue, and you will see several structures being created to see how one can migrate from Companies Act or a private company to an LLP structure in a tax neutral manner. Because again, if you see the overall phenomenon of how the tax is structured, I think none of the companies will be able to get into LLP unless you do a business restructuring around it. So you need to create some sort of a merger, demerger before you are able to convert your company into an LLP. And I think that planning from a timing perspective needs to be appropriately done, because if you are not able to do that timing from a tax perspective, then you can still miss the bus of conversion into LLP. So I think that's going to be very, very important. And generally, I mean, I'm not covering the parameters of what is required in an LLP. I think most of us, from some time or other would have gone into. But my intention of just bringing the LLP was more the DDT planning, as I talked about, because it's very, very, very important, because the flow of monies between the shareholder or the partner is in a very, very different shape, because you just don't pay that DDT. So it's just like a partnership firm, and that just helps from an overall perspective. Whereas retaining, in most cases, the ability of limited liability. DIM dividend is